All right. Hello, everybody, and welcome to the live show. Of course, today we're going to be talking about everything to do with charting techniques in the market. We want to welcome you to another Pepperstone live event. My name is Thomas Atkinson. I'm joined by Ty and Abella. How you going, Ty?
Good, thank you. Welcome, everyone. So, yeah, we've got intermediate night tonight, which is always exciting because we're assuming a pretty reasonable amount of knowledge. So hopefully we can impart some extra knowledge on your already existing techniques and delve into some live charting. So, yeah, looking forward to it.
Absolutely, Ty. So today, as we mentioned, everything's about charting techniques. I'll just switch the screen up now so we can get involved in it. Let's move over here. And of course, what we just need to let you know is that there will be a risk warning. Today is, of course, for educational purposes only. We did see that at the start. Thanks so much for the likes, by the way, guys. Before we got into today's video, really appreciate the support for the stream and for, of course, the live shows that we do once here every 2 weeks for Pepperstone. We're seeing a lot of interest, and we always love your feedback, your participation. If you have questions, ask them throughout. It's a great thing. When you ask a question, your question most likely is going to be asked by 10, 15, 20, 30 people at least that are watching this, if not hundreds. We just want to remind everyone there are some trading groups that Pepperstone offers. So, of course, we have the Pepperstone YouTube, which you're on right now. And then we also have the Pepperstone Telegram group. If you're not part of that, you're a Pepperstone client, so definitely check it out. And if you want to check us out, you can do it so at FX Evolution, either our Discord or, of course, our YouTube channel as well. So what are we going to be covering today, Ty? Well, intermediate charting techniques. You mentioned it. It's the thing we love so much. It's basically going to be going down into some markets right now, taking a look at the multi-time frame approach we like so much. And then, of course, really getting a bit of action in the live charts, finding out how they move, understanding how they move, a little bit of left-hand side analysis today, Ty, getting away from just the idea of a pattern and really breaking down the market the way we like to do it, which is the psychology of the market. Sometimes we mention this, Tyrone, and I think this is a great comment here. We talk to a lot of old school people in the industry, don't we? And those old school people, they've got massive wisdom. They're the ones that really started the pioneering of the charts. And they basically started by taking the data and putting it on pen and paper. And what did they learn out of that, Ty? They learned price action, didn't they?
Yeah, price action, the most important thing you will learn from us, and probably any educational seminar really. Indicators are great; they're a great tool to use, but nothing trumps price action. So, realistically, look, price action is very similar to the motor in the car. You can have a very, very fancy car with all of the fancy wheels and a fancy paint job, but if hasn't got a motor underneath it, it's not going to be as powerful as the one with the big V8. So, price action is a V8. Make no mistake. So, understanding that is like having a very, very fast car.
We all like to have a fast car, I'm sure. So, Ty, types of news events, this is something that we bring up every week. Now, obviously, you want to watch out for these if you're a scalper or a day trader. But in general, if we're following trend, if we're using good charting techniques, I tend to find that news actually does compound into the price action, into the move. So a lot of people are scared of news. I think it's all about the time frame that you pick and whether you want to be a scalper, day trader, swing trader, or investor. They're all going to be a little bit different. An investor may not be as scared of news as, say, a scalper would be. So always remember, news, if you're following trend, often can pack into price, but it's something to be warned for. If you have a calendar, the red is going to be the one that you really want to be watching out for. This Friday is going to be non-farm payrolls, and you guys know what that means. Some volatility around that time. It happens at 8:30 a.m. New York time. Ty, that's pretty much the biggest news announcement of the month, isn't it?
It's the one that you can bank on that people are going to be definitely paying attention to. Look, there's definitely no reason to be scared of news. You just have to understand that it's there and make sure that you're actually trading in a way that it's not going to affect you. That's all you've got to do, really. It's a bit like, look, non-farm payroll is a scary event for some people, but all you really need to understand is that week is going to be probably a little bit slower than the normal week because there is a little bit of anticipation. You're going to have price gravitating to very, very key zones. Support and resistance is going to play a very, very major role, and we'll certainly look at some of those tonight. You'll notice that price will gravitate on a lot of the majors to these very, very important zones prior to the news event. So nothing to be scared of, just not something you have to be aware of. That's what you've really got to focus on.
So, Ty, let's get into the charts. We're here to talk about intermediate price action charting techniques. So we're really not about any one particular basic kind of concept. We're really trying to get in down and dirty on the price action. So let's now talk about this DXY and discuss some of the key things that have happened here. So for anyone that hasn't been looking at the dollar index, if you're a beginner leading into intermediate or even advanced, if you're trading US dollar pairs, you really need to be looking at the DXY, as this is going to form a huge correlation with the euro US dollar and of course other DXY pairs. So if you're trading anything US dollar, this is strengthening, then your other pairs are most likely weakening versus it. Now, we had the massive double bottom here, Ty, and a lot of people know the pattern. Okay, a lot of people know the pattern. But let's talk about an advanced technique of double bottoms, or more of an intermediate technique. And that is that when a double bottom tends to break, there's a few things that we look for in double bottom. It's how the formation has happened on the left-hand side. A pattern is a pattern. Sure, you go and you take the distance, and we move from the distance of A, which is the range here, and we extrapolate that out just like we've done. You'll notice it stops just before. We'll explain that soon. So that becomes B. All very simple. But what we're really looking for here is the price action itself. What did it tell us when it was forming the double bottom? So initially, the market's in a downtrend. There's no doubt. It's in a downtrend. It's actually hugging this 20 moving average a little bit here. That's the red line. We love the 20 exponential moving average. And it forms a base. And this base is quite well rounded, which means it's thought about this accumulation for a while. There's been buyers and sellers. It's then moved up, rejected that area, and then the price action becomes very different here. We get some indecision, but when it starts to boom off, it booms very, very hard. So it effectively kind of V-shapes on this right-hand side. And what's that telling us about price, Ty?
Well, it's telling us that we've seen a big momentum shift off a very, very key zone in the first instance. Now, patterns are great when you identify them, but when you identify them at a very key zone, it makes for an even better story. Now, when you see that big movement off, effectively 4 indecision candles there off a very, very strong base, you're going to have a bit of a good time when you are actually trading or especially anticipating this pattern break. Now, as you can see, it didn't quite get there in the first instance, but remember, this is a weekly chart. This is a very, very no-nonsense serious chart where that contains a lot of price action. So every one of these candles is a significant move of momentum. Now, as you can see, we've had one very, very big week. For those of you who have been following us for a while, we've been following this DX for quite some time. And I know a lot of people have been trading it very, very effectively, even throughout the formation of this pattern. But, this is what technical analysis is. It's history repeating itself and letting momentum and price action lead the way. Price action doesn't come better than, a 300-point weekly candle, does it?
No, it certainly doesn't come better than that. And we have so much great left-hand side knowledge to be had here. You talked about the indecisions. We have the long leg dojis reading the price action here. We have effectively a bearish looking candle. It hits the base. Long leg doji, that's an indecision, a high, a low, the open and the close at the same point. Another long leg doji, indecision. We come off that base. We show a lot of strength. And then what we do is we actually start to coil before the breakout. That is not a bad thing. A lot of people see this as being a bad thing, but actually what it's doing is it's saying, look, we do respect the resistance. When we breach through it, it's the big deal. And then after that breach, we get some more indecision candles. And this is what I really wanted to hone in on today. So let's just look at this after the breach and what happened here on the weekly. Now, you may be saying, but Tom and Ty, I trade the 5 minute, I trade the 1 hour, I trade the daily. It's the same thing, guys. This exact same analysis can be applied to all of those timeframes in the exact same pattern style. If you have a nice accumulation base on the double bottom followed by more of a V kind of rejection, that was a huge base that was being bought by most likely larger players in the markets. That's important. You want to be with those guys. When it breaches and it finds resistance here, what is this left-hand side teaching us? Rejection, again, long leg doji. So we have the high, we have the low, we have the open, then we have the close. Rejection again, kind of like a long leg doji, high, low, open, opens here, closes here. Then it comes down, then it does another one, high, low, open, close. So what is this telling us? This is a seriously big point of rejection. When you close above this rejection, what are you saying? You're saying decision made. When a decision is made, we get the follow-on through. I don't care too much about whether you've got overbought RSI, overbought indicators at this point. We are in trend. We have a pattern with a great storyline, and that's how you read the left-hand side. You need to understand each separate candle. And it goes back to what we discussed when you go to the old school. They read every single candle. They were putting it on the charts daily. They were putting them in and breaking it down to the 4 hours. They understood these charts. And it's like the difference between, I guess you would say, like a professional runner and just something what's an amateur tie. A professional runner, they're not going to sit there and do something fun all the time. They might love their sport, but in essence, how they get so good is they refine their technique and they practice and they practice and they practice. And it's really just the same in charts or anything you're going to be good at, isn't it?
Yeah, most definitely. And when you do actually get good at practicing it, you're going to see these things unfold all the time, and it's not going to be a surprise to you. Just like it wasn't a surprise to us, the price action will really, unfold before your eyes, and then that's when you really start to get a chance to take advantage of it. Really, like that's when you really start to actually, be involved while it's happening, rather than actually looking at it in hindsight, saying, "Wow, I wish I got involved in that." So I think that's why practice makes perfect. They say that all the time, and it couldn't be more true, really.
So this is just an example on the weekly for the DXY, but we've got a few examples to go through. So reading that price action, going back over this video, considering those types of things. Again, it could be a 5-minute, could be a daily, could be a 4-hour. It doesn't matter what time frame you're looking at. The same thing will apply. Get beyond the pattern and start to think about the left-hand side price action. And you'll notice there's some nice follow through couple of weeks. When these become highly statistical opportunities. What's happened so far? Well, we expected it to get to 97 based on the double bottom, and you'll notice it stops just before that. Now, this is again one of those traps that many retail traders fall into. They get greedy, Ty. There's only really two things that are really going to happen in the markets. It doesn't tend to just hit the perfect level and then sell off. It tends to do more of this. Either it comes up, gets very close and stops just before and rejects, or it overshoots in what we really call like a excessive extension phase. So really out here, you could be getting a massive extension where it goes through quickly and then crashes, which happens all the time. I'm sure you've seen it before. Or you tend to get that slightly before the take profit. It very rarely hits perfect, does it, Ty? It's usually a little bit of both.
Yeah.
You got to be watching out for that.
Exactly right. And when you're going for such a big move, look, we've always followed the 80% rule on all of the pattern trades that we've looked at, and it served us very, very well. There's nothing wrong with leaving a little bit on if you need to, and maybe breaking even, but you don't want to be testing the boundaries, really. You want to play it safe. So that's always the safest way to do it, especially when you've had such a big move. So set yourself a target that's realistic in what the pattern actually warrants, but don't try and push it to the nth degree. That is a very, very bad strategy to leave everything running to a particular time. The market is not a perfect mechanism, and it never will be. So you don't want to be aiming for perfect levels.
So what's the price action telling us now? Well, if it closed where it is right now, we've got an open and a close and a low and a high, long leg doji indecision at this peak. So really the DXY is showing us, well, maybe we've hit a key pivotal area. And this brings you on to, of course, discussing the euro. And this is something we've had on the charts for quite some time. If you've been watching for the last couple of weeks, these are supports and resistances that we've watched. And we're using higher time frame analysis to find these zones. We're basically recognizing the closure points on the previous times. And one of the key little intermediate tips that you can use is line chart. A lot of people don't use line charts. Why have I drawn a box here on the charts? Well, because basically this box is showing us the previous resistances, the closures, and becomes a point of interest that I might set an alert for. So line charts show us the close. Again, it's the weekly. Then we can breach down to the daily, and we can start to say, okay, well, now that we've done that top-down analysis, a really more advanced technique for a lot of traders, most of the time when you start, you might only be on one time frame. You start to build the story. And what has the story been so far? Well, the story's been weakness across the board. We've had really great trend lines. We know the euro's been trading very technically. When it breached this zone, as we spoke about a few weeks ago, it was a huge deal. We thought it would come down into these areas. It certainly has. It's come back up. And now what it's dealing with is the 20 moving average, something that it's respected twice so far. So the 20 moving average, key zone, it's hit it. It's rebounded from it. It becomes another point of interest. This is where we expect the selling to stop. This is where we expect the selling to potentially continue based on all these higher time frames. It's quite easy to break down. Then you can start to get down dirty in the smaller time frames. We can get into that and discuss it. Tyrone?
Definitely. I was just wondering, actually, I'm interested to ask the room, how many people actually use the line chart? Does anybody in the room actually go down to a line
Mm.
chart to do their analysis? Because it's a very utilized resource that a lot of people don't
Mhm.
really use probably to its fullest potential, because it makes a very, very big difference when you are trying to sort out what is effectively a noisy market sometimes. So, yeah, it'd be interesting to know how many people actually do
What
use it.
You know what I'd like to know, Ty? What is the chart that you use? Candles, lines, or bars? Which one do you use? There's others, but do you use any of these ones? Obviously, there's a little bit more here. We got Hakanashi, baseline area, ranges, all sorts of things. Point and figure. You remember that one? Points and
Oh, yeah.
figure. God, I have not used that in a long time. But yeah, there's plenty of them. Which one do you use? Candle, line, bar? Let's find out which one you like the most. And I'm sure it's going to be probably candle, but some people might surprise me here. Let's find out if anyone uses the others. Looks like a few people are using line, which is excellent, Ty.
That's
A lot
that's
of big
great.
brains out there in the community, a lot of smart people. That's just excellent. If you work within the boundaries of changing it up a little bit and just bringing a few more tools in that make sense, that's something that's big. Again, an intermediate technique to advanced technique is actually understanding that many indicators, which we're not really covering off on a huge amount of indicators today, they actually all tell you very similar stories. I would guess most people don't even know what MACD is, Ty, yet they use MACD on the charts. Stochastic, very similar. We know this because we've trained a lot of people over years. You ask them what it is, they'll be like, "Oh, it's a thing. I use that."
Yeah.
Is anyone out there like that? If you are, please go and learn about that particular thing. Because
Yeah.
sometimes you might say, I use 4 indicators to get into my order. The problem is 3 of them are going to give you the same signal every time. How often does it happen, Ty?
Happens all the time. One of the biggest lessons is to make sure you understand exactly what your indicator is
Yeah.
trying to tell you. And then you can actually ascertain whether that indicator is copying something else and not contradicting, what you're actually trying to do in the first place. Like, a lot of people say, "Oh, I had 4 indicators telling me that it was going to go long, yet 3 of them are all momentum based." And you're like, you actually only had 1 indicator telling you you're going to go long, and you had 3 of them telling it was going to go short. But without understanding that, they put the numbers on the stacking of which way they want the market to go. So it's really, really important to make sure that each indicator that you have on the chart is telling you a different story, and also understanding that story. Very, very important that you know what that indicator is saying. If you don't know what MACD is, jump into the Pepperstone YouTube channel and go back and see one of our webinars that we did just specifically on MACD. Don't forget, everything that we've always done for Pepperstone is always on their channel. They've got a very, very big backlog. And just like this webinar, which will be available to you as soon as it's finished, the replays are instant. All of them are there for you to be able to watch. So definitely, if you haven't done it and you don't understand a particular indicator or a technique that we're talking about tonight, there's a really good chance we've done a webinar on it in the past. So yeah, definitely jump in and check it out.
So we've got some great questions coming in here, Ty, and some really good examples coming up. But I thought I'd answer this one. Why not? Which time frame is best for day trading? So it does just a little bit depend on the instrument, whether you're trading stocks, whether you're trading currencies, or whether you're trading commodities. But I would say really that 1 hour time frame is very good. 15-minute time frame is more into the scalpy side, but also used quite a lot for confirmations of entry points off the 1 hour. And I like the 2 hour and the 4 hour. Now that may seem like a lot, but these are mostly used for confirmation breaks. So the 2 hour, and I think for day traders, really these timeframes here. Use the daily 4 hour to give you those breakouts both ways. Once you get those confirmations, then you can day trade using the 1 hour, 2 hour, 15-minute. They're all really good timeframes to use. If you start breaking down 45-minute timeframes and get out of it, remember how many people are really seeing those closures. You've got to ask yourself that question. There's a reason why the daily and the weekly are some of the best, because everybody has the time to put in there on those timeframes. Now, what you're seeing on a 1 minute chart, an algorithm might see it, some other traders might see it, but another intermediate technique is actually understanding that not everyone is seeing what you're seeing from the TA level. Let's move over to the pound now. Just another great example, intermediate example here. These are lines that we've drawn in the previous webinars for Pepperstone. So you can go back and check those out. And you'll notice that it hits this level and it bounces off this zone. And there's a few reasons why. We've basically averaged it out, again, using a line chart, showing you more closures, showing you wicks. You get that zone of biggest touch. And some people, what they'll do is, again, you might get the rectangle tool here, highlight the area, highlight it down to the 200 moving average, and it becomes a zone of interest. So basically, if you're in a short, you might want to consider either descaling your position or potentially even removing your position down in these areas. It's quite easy and accurate to do it. And it's not one of those hindsight things. You are using high quality horizontal support and resistance. And I think too many people get carried away in trend lines, Ty. How many charts have you seen? They kind of look like whatever this is doing here, where they've got a trend line here and they go like, they got this. And then they'll go, okay, well, we might, let's do some hotkeys here. We've got Alt T. Oh yeah, we've got some lines and we're done. We've trapped it.
I've seen many a chart that looks like a noughts and crosses board. I can tell you that. The problem with trend lines are subjective. Like there's no question about that, right? We all know that. So realistically, it's really, really important. Just like it is important to understand indicators, it's also important to understand what a valid trend line is versus one that's not. If you don't know that, then you probably don't know what really trend lines they're trying to represent. So, and just very quickly, what we mean by that, a valid trend line means that there's at least a couple of touches on that trend line. But more importantly, there's actually higher highs and higher lows forming to actually make that trend line valid. Once you've got a couple of touches and you've got a higher high, higher low sequence, then you know that you've got a valid trend line. If it's not making higher highs and higher lows, the trend line is not really strong. It's not really potent because it means that the market structure on top is actually weakening and it's not making new peaks. So it's really, really important to make sure that the most simplified price action model, which is the lightning bolt, is actually in play on every trend line that you see. And that will certainly help you filter a lot of the bad ones from that takes away a lot of the subjective, is that really a trend line? If it hasn't got higher peaks and higher troughs, it's not a valid trend line. That's the only thing you need to know. And lower highs and lower troughs, of course, for a smaller time frame going down. Very, very important. A downtrend is going to have lower highs and lower lows. So just so we'll clear that up. Not that I need to. I know this is intermediate. You guys know what we're talking about. But just in case, definitely make sure that it's getting valid higher highs and higher lows or lower highs and lower lows.
So here's another example here, Tyrone. The pound US dollar point of interest, previous support, currently resistance. What have we got? Long leg doji, long leg doji, long leg doji, giant long leg doji. There's so much indecision around here. The market doesn't have clear direction. And a scalper may take advantage of that by understanding there's not going to be a huge amount of movement. It may be trapped in that zone. A swing trader or a day trader may be looking also for a breach of either of these zones. Again, this is the daily, but we can start to break it down to the smaller time frames. Let's break it down to the 4 hour. Okay, so we've had one confirmation, like almost breakout here. So you wouldn't use the 4 hour as your confirmation to break to the upside. You'd be looking for that daily 8 hour or bigger time frame. So we've got a couple of questions coming in about using smaller time frames. So we'll move over here to the pound yen. Now, I think everybody would be able to recognize that this has got a fantastic support on it currently. It's very, very strong here on the weekly. Lots of buying. Again, we're seeing some buying coming through. And every time it's weakened, it tends to find some kind of buyer in this area. If we break it down to the daily, you'll notice it's bounced a little bit here. We break it down to the 4 hour. Again, we're starting to bounce here. And then we can even break it down to something like a 2 hour. And if we bring down this little resistance, you might notice that we have a point of interest over here between this zone, previous resistances. And if we do rally, we have a few other interesting zones. So we have here previous support becoming resistance that's now breached. And you'll notice the price action that's coming off that right now, a bit of a bullish pressure candle. It started to say, okay, well, I've broken to the upside. It looks like I was weakening. I've come down. Now I'm looking like I'm strengthening. What you're looking for here is more of a follow through. Where is the next point of resistance? It's most likely going to be about here. If we breach this area, what's more likely to happen then? To move to the next zone. And where is that next zone? It's going to be up here. So you start to just really trap in really good participation zones. And these are the areas that a scalper or day trader will target. A breach of this area is likely to fill to this area. Once you understand that, especially if you have a higher time frame lightning bolt that we talk about, and I'll get Tyrone to break down that lightning bolt in just a minute. This is a little target area for a day trader to come in. And once you see that breach in the beginning of a session, let's say it happens around an open, the first hour, we start to see that breakout occur on the smaller time frames. That tends to follow through, doesn't it, Tyrone? And this participation can be over in a matter of minutes, if not hours, when you correctly identify it.
Yeah, exactly right. Look, for those of you who don't know what a lightning bolt is, it's our simplified form of higher high and higher low sequences. So it tends to look like a lightning bolt. We call it the lightning bolt because it's generally the first formation of it is a lightning bolt type pattern. So all what you're seeing is price making a higher high, then a higher low. So it makes a trough, a peak, a higher trough, and then a higher peak again. Once you've got that, that is the lightning bolt that we're talking about. And of course, that is the in reverse. Of course, it's a downward moving lightning bolt, which is actually a downtrending lightning bolt. So when we see that, we know all the information we need to know about the time frame that we're talking about. So the smaller time frame, bigger time frame makes no difference. The lightning bolt's always going to be relative to the time frame that you're actually trading anyway. So if you see a lightning bolt on obviously a daily chart, that's a very, very significant lightning bolt because that's a significant price change versus a lightning bolt on a 5-minute chart where you say, well, that's important, but it's only important for what's happening on the 5-minute charts, of course. Whereas on a daily or a 4-hour, it's far more significant for the next few days trading. That's and sometimes weeks in that for that matter. So it's a very, very simple concept, but it's probably one of the most powerful concepts that you can use, isn't it, Thomas?
Well, in essence, every one of the trends really starts this way, and a lot of people never think about this, Ty. Let's ask the room. What is this pattern, guys? Tell me what this pattern is. Tell Tyrone and I what this pattern is while we answer some questions. We want to know that you guys know it. It's intermediate. We expect you know what this pattern is. Let's see if you do.
You should know this pattern, guys. Come on.
While you're at it as well, if you could give us a like on the stream, will help us out. If you enjoy the content, please let Pepperstone know so we can continue bringing it to you guys. If you enjoy it, that's what we're here for. So we've got some questions coming in here. Mr. FX says, where will gold go at NFP day? Wow, that is a huge guess. Look, price action is obviously something you're looking for around that time, but if it's hovering in accumulation, maybe we'll look at gold later on. We will usually see a breakout after NFP. NFP is a very dangerous event to actually trade because it's one of those ones that does a little bit of this. Once you notice a few of them, it does this. Bang, and it goes the other way. So it's a reverser. It's what I call the double whammy tie. If you straddle NFP, and that straddling means you might have a buy order here and a sell order here, and you think, look, I'm so big brain, the market's going to come out, this news, it's going to go like this, it's going to go flying into the sun, the moon, whatever, and come back, and not come back. It's never coming back. You straddle it, and we've been done over by this technique before. Don't straddle. It's pretty bad. So let's have a look if heaps of people have it. Inverse, head, and shoulders. They know, Ty.
Now, Remakant asks us the question, can you recommend a good resource book or course on multi-time frame price action analysis? Well, that is a great question. and a lot of you in the room will actually know this. Our ultimate masterclass is the one-stop shop for that. Don't worry about that. That explains everything you need to know about price action and multi-time frame analysis in depth and how to use it inside patterns, how to use it inside basically all of the things that we talk about with all of the indicators and techniques. So there are many, many books out there about it, but it's the ultimate masterclass that actually brings it all together and explains it in a way that actually makes it simple to understand and in a way that you can actually use it. So yeah, check out the ultimate masterclass. That is the one you want to be going on there.
So here is the example of why I've brought up the inverse head and shoulders that so many of you got correct. And that is because it is in essence a lightning bolt on the right-hand side here. So most patterns really are. Most patterns tend to be so. Even double bottoms, what you'll often notice is it will do this into the breakout. What is that? It's a lightning bolt into the breakout of the double bottom. It happens a lot. So yeah, this is the beginning of a trend. It makes sense it's going to work. But by calling it the lightning bolt, by following that, it becomes like a pattern in your mind. And when it becomes a pattern in your mind, for some reason you believe. There's one thing about TA. People love the patterns. They love the patterns.
Absolutely. And it forces you to actually check. Most importantly, when you're looking for the lightning bolt, you're actually checking for price action to confirm what you're trying to identify. And I think that's the important part. It forces you to actually check. Really, really important.
Superior 7 says NFP almost always whipsaws. You are correct, Superior 7. You must have watched quite a few of them. So the pound yen is just an example of finding multi-time frame analysis, recognizing a support, recognizing some key areas. And, there's lots of things that could go on here. We breached this area. We moved to here. Of course, we do expect some resistance around this zone. Say we consolidate in here for a while and we breach again. Where do we then expect? Somewhere around that 154. If we get through that area, then we may move towards the 155. It's understanding this left-hand side as we're going up that becomes super important. And also just being realistic with your take profits. A lot of people, they tend to not look at the multi-time frame analysis, not look up. And I think I personally was a big problem here, where I used to trade the 5 minutes, the 1 minute, the 15 minutes. And I would say every time I take a trade, 50 pips, guys. That was my thing. I will take 50 pips. Now, I didn't know where exactly it was compared to the other time frames. And that's something that you get with time, you get with a lot of analysis. But if you have one of those fixed kind of take profit zones where you say every time I take 50 pips, every time I have a 20 pip stop loss, all of these types of strategies, unfortunately, most of the time that isn't being market adaptive. It's kind of like I've got a pet peeve with trailing. I don't like trailing by 50 pips. I know a few of you will use it out there. Why not trail by dynamic support or resistance? And this brings us to another one of our intermediate techniques. Sometimes you'll have a trend and you'll think, here's a trend over here. And you'll think, damn, that trend's really, really good. I want to be part of that. And you might notice at the start, it's respecting this 20 moving average. Well, maybe instead of trailing it by 50 pips or trailing it by a traditional fixed stop loss, you might be able to say, okay, well, I'm going to trail it by a 25 moving average, something like that. Do you know how long that kept you in this trend? A long, long time. So using a market adaptive, because remember, a moving average is based on a period of candles behind it. An exponential moving average puts more weighting on the closest candles, and a simple moving average equally weights it across all of those candles. So in a daily, a 20 would be 20 days worth. And then you're following using a market adaptive technique. It's a big deal when you're trying to lock in better profit. We got you, Ty?
100%. 100%.
Yep.
Yeah,
so
no,
that's a huge thing we want to be looking at here. Dab
really
G says I use line charts to help set support and resistance levels, then candles for entries, etc. Yeah, very, very good technique. And Neil says, once you complete the course and Tom and Ty's mentoring program, I've learned so much in the course that I have since I started to trade 3 years ago. I appreciate that, Neil. Thank you very much. It's very much appreciated. All right, so we've done here a few different ones. We've broken down some high time frames. Let's have a look at gold, because there's an intermediate technique I want to talk about here, Ty, and it's called not catching the falling knife. Because you may have identified some amazing levels here, and don't get me wrong, there has been. So this zone here is, of course, a massive point of interest. I've got both horizontals. So we hit a resistance and we start selling off. Let's go into an intermediate technique of how not to get absolutely obliterated by a market that's dumping when you want to buy. And it comes back to something we've discussed before, which is the lightning bolt. So we have the market here falling down. Very sad. Not really, maybe not seasonally for it, but gold, of course, starts at seasonal potentially in December. We'll explain that in a second. And it starts to fall down. And on the left-hand side, there's no doubt this is a key zone. 1832, it started the rally. You expect this to be a point of buying pressure, okay? It's an expectation. It's a good TA expectation. You've correctly highlighted it. The problem is the market starts to accelerate down into this zone. When it starts to fall off a cliff, or some people call the falling knife, you don't necessarily want to catch that. So how do we turn it around? How are we going to not get caned? Did anyone get caned accidentally by gold? Let us know. Or you don't have to let us know if you don't want to, but yeah, let us know, because it's one of those things that I think a lot of people will have been hurt by this trade, and that's just because it's been a bit nasty, but this hopefully will help you. When it hits your green range, so it hits the correct area, what we're looking for here is we're looking for some form of accumulation base. Now, that can be a lightning bolt change of trend, something like a 15-minute even, something an hour, something around here. Are you going to get the perfect price, the absolute scalpel entry where you're so happy that you've got the absolute bottom? No, you may not. You're going to wait for confirmation, but at least then you're giving your trade the best chance of success at these levels. You might give up a little bit of potential, but you won't get caught in these types of positions. So double bottoms on the smaller time frames, changes of trends, channeling patterns, all of these types of things. If you spot them in your range, then you might have a little smiley face, because with the toothy grin, Ty, I'm not, that's a pretty ugly photo. But anyway, you will be looking at it from a bit of perspective of, I've seen what I need to see. And when you get that, you get a bit of confidence. And what you will find is it stops you getting into these entries. And if you've done this here, you get no entry, it just busted straight through. And even here, it looks like it's doing the lightning bolt on the 1 hour. It doesn't break the peak. Now, 1812, if you'd entered there, totally different scenario, okay? Totally different scenario. But it's just like where we are right now with gold. We've found this 1810 as being a resistance. We're accumulating around that. We've kind of broken down underneath, actually, at this stage. And it's a very tough trade at the moment. We're in a point of interest, and we haven't seen the upside potential yet. If the upside comes through here, maybe at that point you're excited. The rest of the market gets excited. Ty, how important is it not to catch the falling knife?
Yeah, it's one of the hardest things to actually get out of your system, because a lot of people feel, especially when they first start out, that it's the best way to trade because you're going to get the big rebound. But it's actually one of the hardest things to do. You really need to understand that price action must prove itself at these key levels. If it doesn't, and it doesn't get caught at a very strong support level, do not touch it. Like it's almost gambling. Like it really is trying to predict when it's going to turn without actually confirmation of a serious time frame. Now, when we're saying, look for a lightning bolt change of trend, we're not talking about, seeing a $30 red candle and then seeing a 5-minute lightning bolt at a level, right? That's not what we're talking about. The bigger the drop and the more aggressive the drop on the bigger time frame, the bigger the lightning bolt has to be to really confirm it. So if you see a really, really sharp fall, don't be looking at a 5-minute chart to try and reverse that trend. What you want to be looking at is a significant time frame, like a 4-hour or a daily. Now, why so long? Because the market has had time to consider it over many trading days. That's why it's important. So the market has had a consideration of that level. There's a chance for consolidation, and there's a chance for market participation to kick back in to the direction that you want to go. So it's really, really important to give it the time. You've got to be patient. So don't just try and reverse the trend on a whim. Don't do anything until you actually see the lightning bolt on a significant time frame. It's a very, very important lesson that most people, unfortunately, learn the hard way.
All right. Reg played here, Ty, says, I thought you were writing Zome. Zome is in this one here for the SMA. So people ask us all the time, 20 EMA, 50 EMA, 200 SMA, what we're using. We use the SMA on the 200 because it's over such a long distance. I mean, basically it's 200 periods. It's 200 of whatever that time frame is. We don't need it to be backing in with the most recent price action as much. Shorter time frames, EMA is usually better, as in the shorter moving average, and the longer one, you can use SMA a little bit more. So thank you for that question. Tyron's so right. It's all about the market having time to really digest that move, to get a bit of an idea about what it wants to do next. And you kind of see that here, Ty. This is a good example of what you're talking about. It starts and it's a little bit weaker. I think here you could have maybe even used a 15-minute 1 hour. It wasn't really falling.
Yeah,
but then it went
at that point,
bang.
That's fine. Yeah, at that point you got a reasonable level, but that's very, very different. 1830 is very, very different to 1780 in the space of about 3 candles.
So here we know there's a lot of weak rejections coming off this zone, but we've got to wait now for this turnaround to happen. And I think the problem is for a lot of people, they don't understand that not taking trades, the trades you don't take, because trading can be boring sometimes, the trades you don't take are actually some of your most successful trades. People have said that to us in the past, Ty, and I don't think I really got it until maybe 8 to 10 years ago, where I understood, that's really true, because it's patience. It's being able to pick specific areas. I want to ask the room this question. How many times, if you're a currency trader out there or gold trader or whatever you're looking at, how many times do you have a family member or a friend come up to you and they say, hey, what do you think's going to happen to the odd US dollar in 6 months? Because I'm going to Hawaii and I need to exchange some money. What do you know where it's going? When's the best time to exchange? When's the best time for me to invest in in this particular asset, and you think, and you literally don't know. I mean, you don't know. You're not going to necessarily know exactly that unless the right TA is going on. Plus, you shouldn't probably tell them anyway. They'll blame you. But the main thing is they ask this question and they don't understand that trading is about taking snippets. It's about taking a little range at a specific time when the stats and the statistics are in your favor for your trading system. Nothing more than annoying than that, Ty. And if you get annoyed by that, you have to click the up button, the tick button on the whatever it is, the thumbs up, because that's something that gets me fired up. I've been asked that way too many times. The old Euro transaction.
Speaking of fired up, nothing fires up our great mate Chris Weston than us getting more likes on our webinars than he does. So please, we've got 200 people watching this, and we've got only 82 likes. If you're enjoying it, please do it, because we know Chris Weston really, really enjoys it. So please hit that like button if you can.
Okay, so we'll go through a few other trades here, or a few other opportunities. Someone mentioned US dollar yen before, and this is one that's been a little bit naughty on the weekly, but I think it does present some interesting zones. So we know this is, again, a weekly. We are using a weekly, but it's just because I know it's here. If there's a 15-minute or a 1 hour that looks very similar to this, they are all used. It's all the same thing, okay? It's all the same thing throughout all the time frames. So we have a really strong resistance here. We know this. Left-hand side teaches us very strong resistance. We then come over to the right-hand side and we say, well, what's going on here? It looks like a little bit of a false break on the smaller time frames. Very nasty. That's a nasty false breakout. You could tell there's wick rejections all over the place. It's gone for a run. It's failed. It's then come back down, and now it's coming back up again. So if we had a closure above this zone here, let's just say, we'll ignore this being a weekly. We'll call it a 1 hour, okay? Because it could be a 1 hour. If we had a 1 hour closure above here, do you guys think that that's a big deal? So it gets above these wicks for the first time ever. Is that going to be a partial confirmation for you? What do you think?
I'd be enjoying it, just quietly.
Well, you're not allowed to answer. The people need to answer. Everybody else. Okay, well, I feel like it's ruined.
Who wants to be a millionaire?
Yeah.
Ask Eddie.
Is it A? Is it A? Is it B? Is it C? And Tyrone yells out. You'd be like that dude in the audience that would yell out, and you'd be like, "It's B! It's B!" And then they kick you out.
Sorry.
Very good. So we get the confirmation closure. Yes, that will be exactly where we're starting to get very excited about it. Now, a lot of people will go, okay, I'm going to enter all my position here. I'm buying. Another intermediate to advanced technique is the concept of scaling. So there's actually quite a lot of value in today's video, guys, because this is a lot of concepts that I think it's probably more even advanced in some ways, because the concept of scaling might be that you might go, okay, well, I've got a certain level of risk, and I want to place half of my order on the closure out. Then as that confirms, let's say it does this, hits this resistance, comes back and moves off, you might have a bullish hammer. You might then say, okay, well, I want to add my other half. You like what you're seeing. You're rewarding the trade. Or it breaches past this zone. And Tyron, what do we feel about that?
Oh, well, that's the lightning bolt we're waiting for. Yeah. And look, what we've got to be really, really mindful of as well is, although this looks a little bit messy and a little bit wicky, you do have to understand that the market has had a very significant scare in the last couple of days. And it's still a little bit scared with the new outbreak of the virus, of course. So, the different variant has sent shockwaves through the market, for right or for wrong. We don't even know anything about it just yet, but it has played havoc with some of these majors. So, it is a little bit more unusually wicked than it normally would be, and has broken down some technicals, because look, at the end, the market shocks are always going to break down technicals. You must keep that in mind as well. So just be very, very mindful that although, we're going to see, occasionally you're going to see very, very big significant events that can't be predicted. No one could possibly predict that something like that is going to come out. You want to be waiting for the close exactly in particular, because especially on the bigger time frames, because a market shock at the start of the week could be really, really good news by the end of the week, and the candle will look extraordinarily different on a weekly chart. So definitely wait for the closes, especially if you're playing the bigger patterns.
You mentioned something before, Ty, and that was what you've been talking about right there is volatility. When we have this VIX, the VIX above 20, we need to pay attention to that, because what that's going to do is, as you said, it's going to send shockwaves through the market. When that happens, investors might come out and say, I want to buy the dip, and they don't necessarily have stop losses. So these guys, they just kind of buy zones they like and stocks they like or particular commodities they like at prices. But you really want to start thinking about bringing out your scalping system and bringing out your day trading system. I think a lot of people get really badly hurt in swing during these periods. And I think you'd agree with me that swing and incredibly high volatility VIX is not a match made in heaven.
Nope.
Swing,
definitely not.
Swing comes in. Yeah. It's all about the technicals. Yep.
That's an arranged marriage gone wrong.
Is it? It's one that you run away in 10, 15 years and then you went and then you change your name. So the VIX here is definitely very big. You know, above 20, start to think about maybe getting rid of that swing trade for the time being. The swing trade works perfect when you're low volatility. That's when the market is acting most technically. It doesn't have these fearful scares in it, those types of things we don't really want on our charts. So we'll get back into the presentation here just quickly, Ty, and we'll ask the room for some questions now. So ask some questions. If you have any questions, then please let us know now. These are some of the common patterns that people use for bases, let's say accumulation. Obviously, if you're shorting, you can use the opposite of this, descending triangle instead of ascending, etc. Double bottom, great pattern. Inverse head and shoulders, obviously a great pattern. Ascending triangles, one of my favorites. I love this pattern because it shows a series of higher lows, which shows strength coming into a break. Think of it like a coil. And of course, the lightning bolt in itself, which is a super important pattern that can appear inside of these, or it is actually a big part of the inverse head and shoulders. So we'll scroll through. These are the types of role reversal you guys should already know by now. We talk about it all the time. We talk about the idea of don't FOMO, boring, technically makes better money. Don't fall into any of these. These are all bad. They're all bad, especially this one here. That's not good. We don't want despondency and depression. We want to basically just be neutralized straight through the middle. And that's not desperation. We want to be neutralized through that line. It's very, very important to do that. This is another system that we quite like, which is the 1, 2, 3, 4. If you have a strong level of resistance that has many touches and it slightly marginally breaks that, when it comes back down, it tends to be a very good conservative entry around this area. So that's something you'll want to spot. You'll notice this is the Euro US dollar D 1 hour. It could be the 15-minute, the 5-minute, really doesn't matter. And if anyone's interested, Ty, we actually got asked a question before about a course. And of course, we do have one over at fxevolution.com. So that's fxevolution.com. You still have a slight extension on our Black Friday sale. Black Friday 21 is the coupon code. You can put it in there. If you have any questions,
we might have to move our photos, Thomas, because our photos, our videos are covering.
I blocked it. That's not good. 1 second here. There we are.
It's not. It's not Thai Friday. Definitely not Thai Friday.
No. It's not that. So I'll check that on the screen. You get 1 month access to our thing. So let's answer some questions here. And there's a question here looking to look at the odd US dollar. If you're interested in us checking that out, we will be doing that in the webinar we run after this over at FX Evolution on YouTube. What else do we have here, Ty? You've got any questions that have come through?
We have got a lot of them with the moving averages. We've already answered those. We've had some great, we've had a lot of participation tonight. Look, thank you so much for all of your comments and kind words. Actually, it seems that we're getting quite the repeat viewers, which is awesome because it means that you're really building on the knowledge that you probably already understood from some of our webinars. So hopefully you can really pick up and run with some of the stuff that we've talked about tonight, because this has been a very no nonsense webinar. When Thomas and I are both dressed in white, we're serious. So make no mistake, the stuff that we talked about tonight is very, very important. And if you did miss some of it or you didn't understand some of it, be sure to check out the replay, because it's really, really important nuts and bolts sort of things for all manner of trading, whether it's swing trading, scalping, or even the longer term. Really, really important.
So there's a few questions here. I'll just quickly answer a few here, Ty. There is one coming in from Sultan. I would recommend you email Pepperstone with your question. It's about just some stuff with Pakistan. I'm not sure on that. So just make sure you email Pepperstone. They'll be able to help you out. And then we have Reg Blades says, for someone who understands charts but never got into FX trading properly, which course would be suitable? I would say ours is suitable for all markets, commodities, FX, stocks. We have a stock section in it. We have everything in it. It's the ultimate masterclass for a reason. We put 10 years into it, so it's pretty big. Why? Chin Chin says, is it worth looking at volume to confirm patterns? Any tips on what to look for? Yes, but depends on the market that you're looking at. So say you're in Tesla and you're trading Tesla and Pepperstone, then yeah, you would use volume. Absolutely. Volume will help a lot. And you're looking for volume off the accumulation base. So let me give you an example here as we finish up. You've got an accumulation base. Now, if you start to see at the end of this accumulation some volume spikes, so volume starts to get a little bit bigger here, what's happening really is that someone is starting to add to their position. And this is probably a bigger fund saying, okay, boys, it's time to go. Let's do it. And they start moving it through. So they're basically investing in it. They're starting to take out those lines, and there's a bigger amount of transactions in that. So the salad lines are getting wiped out. And then as it breaches, ideally you would get the peak or the crescendo of that volume. Now, it doesn't always happen like this, but that's where you would use volume. And it can be very helpful. It's multiple ticks to use that during stock analysis for sure.
Definitely. And also in reverse as well. If you see, a pattern about to break out, but the volume starting to get lower and lower, that's also a key sign that this could be a fake out. So just be very, very mindful of that as well. It can be used both ways for volume increase and volume decrease.
Reg has the question, is the training recorded or live one-on-one? For the Ultimate Masterclass, it is all sessions. It's a mixture of quizzes, tutorials, and video recordings. If you wanted to do one-on-one or group mentoring in general, we do offer that as well. A few people.
The Ultimate Masterclass has 470 questions that you have to answer to pass it. It's actually easy to become a lawyer. So it's very.
I think that might be a bit of a mistake.
It's easy to pass the bar than it is to actually pass the Ultimate Masterclass.
All right. So thanks so much. Obviously, Pepperstone's got some exciting new technology coming towards the end of the year, I believe, Ty. They've got some things out in beta, and I think there's some very great platform discussion to come up as well. So hopefully that all starts to come through. I saw some of the members of Pepperstone talking about it before. We'll leave you with a quick outro here, just with a bit more of a risk disclaimer so you can see it. If you did enjoy today's session, please vote with your likes. Let them know that you want us to keep coming back and do this. And for both Tyrone and I guess we'll say thank you very much for watching. We hope you enjoyed it. We hope you learned some tips out of today. And we look forward to bringing you more intermediate, beginner, and of course, advanced techniques over time. There's plenty to learn. And the great thing is we never stop learning. We always keep going, don't we, Ty?
Most definitely. So we are on again in 2 weeks' time, team. So keep an eye out for your invites. 2 weeks' time will be our final Pepperstone webinar for the year. Looking forward to actually really seeing what the markets give us over the next few weeks. We generally get some pretty good action. So certainly check out all of the strategies that we talked about tonight. Keep an eye out, and we'll pretty much wrap up the year and what is ahead for Christmas in about 2 weeks' time. Thanks, everyone, and we look forward to seeing you then.
Thanks so much, guys. Bye for now.